It's over, not the market. Not yet. But something deeper just snapped beneath the surface. On February 5th at 2:47 p.m. Eastern, while headlines stayed calm, while stock charts barely moved, the financial plumbing that keeps trillions moving overnight froze. Repo rates didn't drift higher. They didn't gradually climb. They exploded from a normal 4.5% to over 9%. In hours, 14 institutions tapped emergence liquidity in a single session. 14. That number hasn't been discussed on TV, because by the time it shows up in reports, the smart money has already moved. This isn't panic, you can see. It's panic you feel when the pipes stop flowing. And when overnight cash disappears, the countdown begins. So the real question is this: was February 5th just a spike or the first crack before something much bigger breaks? Welcome to Market Metal. If you've been through a few market cycles, if you've seen 2008, 2020, or even the slow burn of the last few years, then you already understand that the quiet warnings matter most. If this breakdown helps you think clearly, not emotionally, do me a small favor. Subscribe to the channel, not for hype, but for steady, calm analysis you can trust, and tell me in the comments, where are you watching from today? City, state, country? Let's see how far this conversation reaches. The signal beneath the surface, what actually happened. In the early afternoon of February 5th, something shifted beneath the surface of the financial system. It did not begin with a stock market crash. It did not appear first on major news headlines. Equity indices moved, but not in dramatic fashion. To the casual observer, nothing seemed unusual. Yet inside institutional trading rooms, attention turned quickly to a market most people never hear about, the overnight repo market. Repo, short for repurchase agreement, is not a product sold to retail investors. It is not discussed in mainstream financial programs unless something has already gone wrong. It is the hidden infrastructure of modern finance. Banks, broker-dealers, hedge funds, and money market funds rely on it every single day. It allows institutions to borrow cash overnight using U.S. Treasury securities as collateral. In simple terms, one institution sells Treasury bonds to another and agrees to buy them back the next day at a slightly higher price. That price difference represents the interest rate, the repo rate. Under normal conditions, this rate closely tracks the Federal Reserve's policy rate. It moves in small increments. A few basis points higher or lower is routine. Stability in this market signals that liquidity is flowing. Institutions trust one another. Collateral is accepted. Cash is available. But on February 5th, stability broke. Repo rates, which had been trading near the expected range, suddenly spiked sharply in a matter of hours. This was not a gradual climb over weeks. It was a fast, concentrated surge. In professional markets, speed matters. A sharp spike in an overnight funding rate tells traders one thing: someone needs cash urgently, and the supply of that cash is limited. The move was large enough to attract immediate attention from funding desks in New York, London, and Tokyo. These desks monitor liquidity constantly. They understand that when overnight borrowing costs jump suddenly, it reflects stress, not necessarily insolvency, but stress in the system's ability to fund itself. At the same time, another signal appeared. The Federal Reserve's standing repo facility, an emergency backstop designed to provide liquidity when private markets tighten, was accessed by multiple institutions in a single session. This facility exists to prevent panic. It is used when institutions cannot obtain funding easily in the open market. Its use is public, but reported with a delay. By the time data becomes widely discussed, the immediate stress has already occurred. To experienced observers, the combination of a rapid repo rate spike and increased reliance on a Federal Reserve facility is not random. It is a signal. It suggests that liquidity demand exceeded available private supply, at least temporarily. For business leaders and entrepreneurs, this may sound distant. They do not operate trading desks. They are not borrowing overnight against Treasury securities. But the repo market is not isolated from the real economy. It is the financial plumbing that allows banks and financial institutions to manage daily cash needs. If that plumbing tightens, lending behavior can change quickly. The important distinction here is between price volatility and liquidity stress. Markets experience volatility regularly. Stocks rise and fall, bond yields move, currency rates shift. Volatility alone does not signal systemic danger. Liquidity stress is different. Liquidity stress means participants are unsure whether they can access cash when needed. In modern finance, institutions operate with large balance sheets. They hold securities worth billions or even trillions of dollars. These securities are often high quality, such as U.S. Treasuries. However, holding assets is not the same as holding cash. If an institution must meet margin calls, investor redemptions, or settlement obligations, it needs immediate liquidity. Under calm conditions, that liquidity is available. Repo markets function smoothly. But when demand for cash rises suddenly, perhaps due to margin pressures, portfolio adjustments, or broader macro uncertainty, the cost of borrowing cash increases. If lenders hesitate, rates rise even faster. This is what makes February 5th notable. The spike was not about stock prices falling dramatically. It was about the cost of overnight liquidity jumping quickly. Such jumps do not occur without reason. To understand why this matters, one must consider how financial institutions are structured. They manage assets that fluctuate in value as interest rates change. Over the past several years, interest rates have risen significantly compared to prior lows. When rates rise, the market value of existing bonds declines. Institutions that purchased bonds at lower yields now hold assets worth less in market terms. Many of these losses remain unrealized. As long as institutions do not sell the bonds, they do not record the losses in full. However, if liquidity pressures force sales, losses become realized. That possibility changes behavior. It encourages institutions to secure funding without selling assets at depressed prices. When repo rates spike, it can indicate that institutions prefer to borrow at higher short-term costs, rather than sell longer-term assets at losses. That behavior, multiplied across many participants, creates pressure in funding markets. Observers of financial history understand that liquidity problems often emerge quietly before larger events. In past crises, early signs appeared in funding markets rather than equity markets. This does not mean that every repo spike leads to a crisis. Markets can experience temporary dislocations. Central banks can stabilize conditions. Liquidity can return. However, the first 48 hours after a funding shock are critical. They reveal whether stress is contained or spreading. If repo rates fall back quickly and facility usage declines, the episode may prove temporary. If rates remain elevated and emergency facilities continue to see demand, stress may deepen. Markets watch these signals carefully. For the business community, the takeaway is not fear. It is awareness. Liquidity conditions influence credit availability. Banks that face higher funding costs may tighten lending standards. They may become more selective with loans. For entrepreneurs seeking capital, subtle shifts in funding markets can translate into slower approvals, higher interest rates, or reduced credit lines. The February 5th spike serves as a reminder that the financial system is interconnected. Treasury markets, repo funding, bank balance sheets, and small business lending are linked through a chain of liquidity. At this stage, no collapse has occurred. No major institution has failed. Equity markets continue to function. Yet beneath the surface, the cost of overnight money moved sharply. Institutions tapped backstop facilities. Funding desks responded with caution. Experienced analysts do not dismiss such signals. They observe them. They measure follow-through. They monitor short-term Treasury bill yields, secured overnight financing rates, and credit spreads. These indicators show whether liquidity is stabilizing or tightening further. For now, the event stands as a warning signal, not a conclusion. The next phase depends on how markets respond in the hours and days that follow. In liquidity cycles, speed matters. Confidence can return quickly, or it can erode further. What happened on February 5th was not a headline crash. It was a structural tremor in the financial system's plumbing. And in funding markets, plumbing matters. The pressure beneath the balance sheets. What made the February 5th spike more than a technical event was not just the rate move. It was the environment in which it occurred. Liquidity does not tighten in isolation. It tightens when pressure builds quietly beneath the surface, on balance sheets, in bond markets, and in the flow of government financing. For years, financial institutions operated in a world of low interest rates. Bonds yielding 1% or 2% were considered normal. Banks purchased large volumes of Treasury securities and mortgage-backed bonds during that period. These assets were viewed as safe, stable, and predictable. They carried minimal credit risk. In accounting terms, many of them were classified as held to maturity, meaning institutions did not plan to sell them. Then rates changed. As central banks raised policy rates to combat inflation, yields on new bonds increased sharply. When yields rise, existing bonds lose market value. This is not speculation. It is a mathematical relationship. A bond paying 2% interest is worth less in a market where new bonds pay 5%. The only way to match the higher yield is for the older bond's price to fall. On paper, banks across the system began carrying assets worth less than their original purchase price. These were unrealized losses. They did not immediately threaten solvency. If the institutions could hold those bonds until maturity, they would still receive full principal repayment. The danger emerges when liquidity is required before maturity. If depositors withdraw funds, if margin requirements rise, or if market volatility increases collateral demands, institutions need cash quickly. To raise cash, they must either borrow or sell assets. Selling assets at depressed prices converts unrealized losses into realized ones. Borrowing in the repo market delays that recognition, but only if funding remains available at reasonable cost. This is where the suspense deepens. On February 5th, repo rates did not drift higher gradually. They surged. That surge signaled that institutions were choosing to borrow aggressively rather than liquidate positions. It suggested that some participants were under funding pressure and were willing to pay nearly double the normal overnight rate to secure liquidity. The broader system is carrying trillions of dollars in securities whose market values fluctuate daily with interest rate movements. These positions are not inherently unstable, but they become fragile when combined with rising funding costs and shrinking system liquidity. Liquidity itself has been tightening through policy. The Federal Reserve has been reducing the size of its balance sheet. This process, known as quantitative tightening, removes reserves from the banking system. When the central bank allows bonds to mature without reinvesting the proceeds, cash drains from institutional balance sheets. At the same time, the U.S. Treasury has continued issuing large amounts of new debt to finance government deficits. Every new Treasury auction absorbs capital from the private sector. Investors must allocate cash to purchase those securities. That cash does not remain freely circulating in short-term funding markets. When central bank tightening and heavy Treasury issuance occur simultaneously, the supply of liquidity declines while demand for it rises. This dynamic creates structural pressure. Consider the sequence. Banks hold bonds purchased at lower yields. Those bonds are underwater in market value. Funding costs increase as repo rates rise. Liquidity drains from the system through balance sheet reduction and government issuance. Institutions facing even moderate funding stress must borrow at higher rates or sell at losses. This is not an immediate collapse. It is a tightening spiral. Each rise in Treasury yields deepens unrealized losses. Each unrealized loss reduces balance sheet flexibility. Reduced flexibility increases reliance on short-term funding. Increased reliance raises sensitivity to repo rate spikes. Higher repo rates amplify funding stress. This feedback loop is subtle but powerful. Entrepreneurs and business leaders rarely monitor repo spreads, yet the consequences eventually reach them. Banks under funding pressure often respond by tightening lending standards. They reduce risk exposure. They increase interest rates on new loans. They reassess credit lines. Expansion plans that once looked viable become more expensive to finance. History shows that liquidity stress often precedes visible economic contraction. It begins in funding markets because those markets respond first to shifts in confidence. Confidence is not emotion, it is calculation. Lenders ask whether borrowers can repay. Borrowers assess whether funding will remain accessible tomorrow at a reasonable rate. When doubt enters that calculation, rates adjust quickly. The February spike may prove temporary. Liquidity episodes sometimes resolve within days. Central banks can inject reserves. Treasury issuance schedules can adjust. Market participants can rebalance portfolios. But if repo rates remain elevated or repeat the pattern, the signal becomes stronger. It would indicate that liquidity is not merely tight for a day, but structurally constrained. This is the suspense facing decision makers. They must determine whether they are witnessing a short-lived funding dislocation or the early phase of broader liquidity contraction. The stakes are strategic. In periods of tightening liquidity, capital becomes selective. Strong balance sheets gain advantage. Weak balance sheets face scrutiny. Businesses reliant on continuous external financing feel pressure first. Those with internal cash reserves gain negotiating power. The market has not declared crisis. It has delivered a warning. The tension lies in what comes next. Will liquidity normalize quietly, restoring confidence? Or will further data reveal that funding demand continues to outpace supply? Over the next 48 hours following such a spike, analysts watch closely. They observe standing repo facility usage. They monitor short-term Treasury bill yields. They compare secured overnight financing rates to policy targets. They track credit default swap spreads on major banks. If these indicators stabilize, the system absorbs the shock. If they intensify, pressure compounds. The power of this moment lies not in panic, but in uncertainty. Liquidity stress does not announce itself loudly. It appears in technical charts and funding reports before entering headlines. For disciplined observers, February 5th was not an isolated statistic. It was a signal embedded in the mechanics of finance, and signals matter, especially when balance sheets are already carrying hidden strain. But when liquidity tightens, the real economy feels it. Liquidity stress rarely stays confined to financial plumbing. It begins in technical markets, overnight funding, collateral spreads, facility usage, but if it persists, it moves outward. It reaches credit desks, it reaches corporate finance departments. Eventually, it reaches operating businesses. The question facing serious observers after February 5th is not whether a rate spiked. It is whether that spike marks the beginning of contraction in credit availability. Banks do not operate in isolation from funding markets. Their ability to lend depends on their access to stable liquidity. When overnight funding becomes more expensive or uncertain, internal risk committees react quickly. They do not wait for headlines. They adjust. First, they reassess exposure. Credit officers examine loan books more closely. They tighten underwriting standards. Margins widen on new loans. Approval processes lengthen. Borrowers with weaker financial statements receive more scrutiny. Lines of credit that once expanded easily are reviewed. This shift does not appear dramatic at first. It shows up quietly in slowed loan growth statistics. Commercial and industrial lending flattens. Revolving credit utilization increases as businesses draw down existing lines, sensing caution in their banks. At the same time, another layer of pressure builds in asset markets. Financial sector equities are particularly sensitive to liquidity stress. Banks, broker-dealers, asset managers, and insurers rely on stable funding. When repo markets tighten, investors begin pricing in risk, even before earnings decline. Share prices adjust not to current insolvency, but to the possibility of future constraint. The speed of adjustment is important. Markets reprice faster than economic data updates. A liquidity shock today can affect equity valuations tomorrow. Yet the real economy may not show signs of strain for months. This lag creates suspense. Business leaders must interpret signals before official statistics confirm them. The short end of the Treasury yield curve becomes a critical indicator in this environment. When 1-month and 3-month Treasury bill yields begin rising relative to longer maturities, it suggests institutions are paying a premium for immediate liquidity. That premium reflects urgency. It reveals that short-term cash is more valuable than long-term return. The Secured Overnight Financing Rate, or SOFR, offers another lens. If SOFR trades persistently above the Federal Reserve's target range, it signals that private funding markets are under sustained pressure. Temporary deviations are manageable. Persistent divergence is not. Credit default swap spreads add yet another layer. When the cost of insuring against a major bank's default begins widening, it shows that counterparties are recalculating risk. This does not mean collapse is imminent. It means uncertainty is increasing. For entrepreneurs and business operators, these indicators may seem abstract, yet their consequences are concrete. Imagine a mid-sized manufacturing firm planning to expand capacity. It relies on a variable rate loan tied to short-term funding costs. If repo stress lifts short-end yields, borrowing costs rise. Expansion becomes more expensive. Timelines shift. Consider a technology startup dependent on venture capital rounds. If liquidity tightens, investors preserve capital. Funding cycles slow, valuations compress. Growth projections are revised downward. Even well-established firms with strong cash flow feel second-order effects. Suppliers may request faster payments. Customers may delay receivables. Working capital management becomes critical. This is how liquidity cascades through the system. It begins with funding desks seeking overnight cash. It progresses to bank committees tightening risk. It moves to capital markets repricing financial stocks. It finally touches businesses through credit availability and cost. The suspense surrounding the February event lies in the feedback loop. If banks tighten lending, economic activity slows. Slower activity increases default risk. Higher perceived default risk further tightens lending. Meanwhile, rising Treasury yields continue pressuring bond portfolios, deepening unrealized losses. Confidence is the bridge holding the system together. Financial systems function because institutions believe liquidity will be available tomorrow at predictable cost. Once that belief weakens, behavior changes quickly. Institutions hoard cash. They delay investment. They reduce leverage. Markets can recover from volatility. They struggle to recover from distrust. In this phase, psychology and mathematics intersect. Traders calculate funding spreads. Executives calculate capital expenditures. Investors calculate risk-adjusted returns. Each calculation reflects the same underlying variable, liquidity. The power of the current moment is not in dramatic collapse. It is in quiet adjustment. Observers who focus only on stock indices may see limited movement. Yet beneath that surface, decisions are being recalibrated. Funding desks are shortening duration exposure. Portfolio managers are reducing leverage. Risk officers are elevating liquidity metrics in internal meetings. The next 48 hours, following a funding shock, determine narrative direction. If repo rates normalize quickly and emergency facility usage declines, confidence stabilizes. Institutions interpret the event as a temporary imbalance. Risk appetite gradually returns. If stress persists or intensifies, perception shifts. Market participants begin preparing for prolonged tightening. Equity volatility increases. Financial stocks underperform. Credit spreads widen. This is the suspense facing decision makers. They must evaluate whether the February spike was an isolated funding imbalance or the opening signal of a liquidity contraction cycle. Entrepreneurs and business leaders cannot control repo markets, but they can control their response. They can monitor funding conditions. They can strengthen balance sheets. They can preserve optionality. Liquidity cycles reward preparedness. Those who anticipate tightening maintain flexibility. Those who assume stability may find themselves reacting under pressure. At this stage, no collapse has occurred. The system remains functional, yet funding markets have delivered a warning. And in financial history, warnings often arrive before visible stress. The question is no longer whether a rate spiked. The question is whether confidence will return quickly or whether the tightening spiral has just begun. The decision window, positioning before the system, decides. In moments of liquidity stress, the most dangerous position is not being wrong. It is being unprepared. By the time funding pressure becomes visible in earnings reports or unemployment data, strategic flexibility is already narrowed. Capital becomes selective. Credit becomes conditional. Timing becomes critical. The February repo spike did not declare crisis. It created a decision window. Serious business leaders understand that markets move in phases. The first phase is signal. The second is recognition. The third is response. The current environment sits between signal and recognition. Liquidity stress has surfaced. The broader market has not yet fully adjusted. This creates asymmetry. In a tightening cycle, yield becomes less important than liquidity. The ability to move capital quickly, to withstand temporary volatility, and to deploy resources opportunistically outweighs the pursuit of marginal return. The first principle in such an environment is simple. Preserve optionality. Short-duration liquidity becomes valuable. Treasury bills with maturities under 3 months carry minimal duration risk. They provide flexibility. They allow capital to remain mobile while uncertainty resolves. Long-duration bonds, in contrast, expose holders to yield risk. If rates continue rising due to funding strain or heavy issuance, long-dated assets decline further in value. Preserving capital is not defensive behavior. It is strategic positioning. The second principle is counterparty awareness. Most modern assets carry some form of counterparty exposure. Bank deposits rely on institutional stability. Brokerage accounts rely on custodians. Bonds rely on issuers. In stable periods, these risks appear remote. In tightening periods, they are reevaluated. Diversification of banking relationships becomes practical, not theoretical. Ensuring deposit levels remain within insured limits becomes operational discipline. Businesses reassess concentration risk with suppliers and financial partners. None of this signals panic. It signals prudence. The third principle involves patience, a discipline often overlooked in active markets. Liquidity stress creates forced selling. When funding costs spike and margin pressure rises, institutions liquidate assets to stabilize balance sheets. This selling can compress valuations across entire sectors, particularly financial stocks. History demonstrates that strong institutions are sometimes priced as if they are failing during peak stress. The key distinction lies in balance sheet strength. Institutions with low leverage, diversified funding sources, and strong capital ratios often survive liquidity contractions and emerge stronger. However, timing matters. Entering distressed positions before funding stress peaks exposes capital to further decline. Strategic investors wait for confirmation, sustained volatility, widening credit spreads, and visible central bank response. Only when panic reaches extremes does asymmetry favor selective entry. This requires discipline. The fourth element of positioning is monitoring. Forward-looking leaders do not rely on headlines. They track indicators. They observe the Federal Reserve's standing repo facility usage. If access continues climbing beyond initial spikes, stress is persistent. They monitor the spread between SOFR and the Federal Reserve's policy rate. Sustained divergence signals structural funding strain. They watch short-term Treasury bill yields for abnormal moves relative to longer maturities. They analyze credit default swap spreads on major financial institutions. Widening spreads reveal rising counterparty concern. These indicators collectively reveal whether liquidity is stabilizing or tightening further. The suspense surrounding the current environment lies in policy response. Central banks face a strategic dilemma. Tight policy restrains inflation but compresses liquidity. Intervention restores liquidity but risks undermining policy credibility. If authorities step in quickly with expanded liquidity measures, markets may stabilize. If they hesitate, allowing funding stress to intensify, risk repricing accelerates. Business leaders must prepare for both scenarios. If liquidity stabilizes, capital markets reopen gradually. Credit flows resume. Expansion plans can proceed with caution. If liquidity contracts, credit becomes scarce. Risk premiums rise. Asset prices adjust lower. Those with preserved capital gain negotiating leverage. The difference between these outcomes may unfold within days, not months. The most important insight for entrepreneurs and executives is this. Liquidity cycles are not moral judgments. They are structural mechanics. Systems built on leverage and credit expansion require stable funding. When that stability weakens, recalibration begins. Prepared leaders focus on resilience. They reduce unnecessary leverage. They strengthen cash positions. They stress test revenue assumptions. They ensure flexibility in supplier and customer relationships. They do not assume crisis. They prepare for volatility. The February spike was a tremor in the system's foundation. Tremors do not always become earthquakes, but they signal movement beneath the surface. Over the next phase, markets will decide whether funding stress resolves quietly or intensifies into broader contraction. Those who ignore funding signals wait for headlines. Those who study them adjust before confirmation. The decision window remains open, for now. Liquidity has not disappeared, confidence has not collapsed, but the system has revealed strain, and in finance, strain precedes outcome. The next 48 hours will not determine the entire cycle. They will determine direction. The leaders who navigate this period successfully will not be those who reacted emotionally. They will be those who understood that liquidity, not headlines, drives markets. The signal has been delivered. The positioning phase has begun. The system will decide what comes next. The question is whether decision makers are already prepared.